What's going on? Alex here, and today I'm answering your questions from Reddit. Alright, this question comes from Nighton J. Currently have a job that offers no retirement benefits. What can I do to save for the future? They don't offer a 401k. Other than a Roth IRA, which is limited to $5,500, what else can I do to save for the future? Do I just save using a regular taxable account? Alright, so here's my question. Why is it that the taxable accounts get no love? It's a beautiful thing to have a taxable account, and we should embrace the ability to maintain a taxable account in addition to all of the other retirement accounts and qualified accounts that we may have. Because as I mentioned in a prior video, it's important to have 3 different buckets of assets, right? So the first one is your pre-tax qualified monies. So those would be the 401k assets and the IRAs that you have to which you contributed on a pre-tax level. They're going to be taxed later. They're tax deferred. So they're kind of sitting in this bucket where you can't access them unless you pay income taxes. And also if you're below age 59 and a half, you'd also be subject to penalties to access those monies. So that's important to have because you can contribute to it on a pre-tax basis, and it'll give you tax benefits now, so you can allow that money to grow tax deferred. Now, on the other hand, there's also qualified post-tax monies, or monies on which you did pay taxes on. An example of this would be a Roth IRA. That's also important to have because that money you can access, at least the principal, at any time without paying taxes on it or being subject to penalties. So it's a great amount of flexibility if you have both of those. Now, the third bucket are the taxable assets. Now, you may have to pay capital gains to access those monies, but they are available to you, and often it's at a lower tax rate, at least for federal tax purposes, than you would have to pay to access IRA monies that are pre-tax. So on top of paying long-term capital gains rates if you hold stocks for long enough in a taxable account, you also benefit from something called qualified dividends, which generally means if you don't churn the account, if you keep the assets in there for a long enough period of time, then you're able to avoid paying ordinary income tax rates on the dividends that you receive out of those funds and out of those stocks that you hold in that taxable account. Instead, they would be taxed under the long-term capital gains rates that I mentioned earlier. So again, you're getting preferential tax treatment. So as those monies grow over time, all the dividends that get reinvested, you're going to be taxed on the dividends. But if you hold the stocks for long enough within that account, then they're going to be subject to long-term capital gains rates as opposed to ordinary income rates, which is beneficial for you. Then when it comes to time to access the money, if you've held a stock or ETF for a year and a day, then you can enjoy long-term capital gains rates on that. So any appreciation that has occurred on those funds and on those stocks is going to be subject to that preferential tax rate. And if your income is low enough, you may not even pay any taxes to access those monies. So that's an important thing to consider. And we don't know which way tax laws are going to change in the future. So are they going to increase the taxes on capital gains? Are they going to increase ordinary income tax rates? Who knows? The important thing is to be diversified across those 3 buckets so that whatever happens, you're in a good situation to where you can pick and choose from where you access your wealth so that you can control the amount of taxes that you're subject to at any particular point. Hopefully that was helpful. The taxable accounts definitely need more love. But if you have any other questions, hit me up with the comments below. Thanks for watching.